Hello, Dr. Tim Creel here. Going to talk a little bit about Chapter 3 of Auditing. Go ahead and pull up the presentation and start the presentation. Okay, so basically what this chapter looks at is kind of getting rolling on the audit engagement. What do you do beforehand, and what are some of the things you do when you're kind of starting getting the engagement rolling? So, kind of your pre-engagement activities here. Um, your first decision would really come down to, do you take on a new client or retain a current client? And the big thing here is you want to look at the ethical nature of leadership of a new client, or really a continuing client as well. If you find that, like, for example, if you were an auditor and you found that a current client was constantly trying to mislead you, then maybe you should not be their auditor. Maybe you should decide that, okay, this is going to be our last year. We're tired of this. And when you're looking at a new client, you would very much look at the ethical nature of leadership of that company, and the tone at the top. Um, this is a big business decision. And the thing is, if you go back and look at things like Enron and stuff, the role of the audit firm in this, um, there could be lawsuits, there could be a lot of things that could come out of having a relationship with a bad client that could really hurt an accounting firm. So accounting firms need to be selective in who they choose as their clients, and trust and the ethical nature of leadership, the tone at the top, is very important to look at. Another thing too here is, if you're taking on a new client, you're required to have a conversation with the predecessor auditor, with the prior auditor. Now, you have to, and basically you would just ask that predecessor auditor, why did you leave? Were there any issues? You would just gather information from them. Now, one thing I want to say is, though, is that in order to have this conversation, you've got to get permission from the prospective client. Now, one thing too to think about as an auditor here, if the prospective client denies you permission to speak with the predecessor auditor, that might be a hint that maybe this is not a client you want to have. And so again, it all kind of goes back to the tone at the top and the leadership ethics of it. But in this conversation with the predecessor auditor, again, you can discuss things like, why did you leave? Why are you not their current auditor? Was it your decision? Was it their decision? You could ask some basic questions, and they're not going to get too detailed with you, but it can kind of help your understanding of the situation and why a change in auditor was made. And it can help you make your decision as to whether if you want to accept this client or not. Now, client acceptance and continuation policies. Typically, companies have some, again, policies in place that, again, if they feel like those policies aren't being followed, then they should not accept a new client, or that they should not continue on with a client that they've got now. Now, the company must file an 8K form with the SEC if they change auditors. This would be up to the company to do, and they would have to file it within like 3 days of the change to the SEC. And I think in the last chapter, on one of the last pages, I gave you a link to the SEC Edgar site, where companies have, you can look at any 8K report, 10K report, 10Q report that companies have filed. So it's a great site if you want to learn information about a company. The engagement letter. Your book has a copy of an engagement letter. And what an engagement letter does is, it's where it's written from the firm, and it's if they've decided to accept the relationship with the client for either continuing or as a new client. And it kind of develops an understanding with the client and acts as a contract. So the auditor will put that we're going to audit your financial statements, that our audit's going to follow PCAOB standards, and they put some information on there about fees and the like, and then the firm signs it, and then it's sent to the company, and the company president, CEO signs it, and then sends it back to the audit firm. It kind of, again, is kind of an understanding that we're going to be your auditor. This is how we're going to do our audit. This is what we're going to audit. And basically, this is what our fees are going to be, our fee structure is going to be, and kind of develops that understanding between the auditor and the client. And also, a termination letter would be sent to the former client. If a company declines to continue forward with the client, then they would send a termination letter to that former client, just stating that we're not going to be your auditor anymore. Now, an audit plan, this is an important part of the process. Once you've agreed to be the auditor, either on a continuation or with a new client, you've got to start the audit planning. Now, the auditor must come up with a plan to document the nature, timing, audit procedures to assess the risk of material misstatement. Also should plan the nature, timing of test of controls and substantive test. So you're kind of lay it out here. And a big thing that you want to do is design, okay, when are you going to test their system of internal controls? And the system of internal controls is also going to come back and let you know about the level and types of substantive tests you're going to do as well. So typically when you're doing your plan, you want to examine their system of internal controls early in the process, because that could change some aspects of your substantive test depending on what you find as far as the strength of their system of internal controls. A really strong system of internal controls um, basically could allow you to trust more internal uses of the internal sources coming from the company, could allow you to rely on some lesser tests sometimes and still adequately support, the financial statements and support the evidence or the quality of evidence you need to gather as an auditor. Where if you find very weak controls, you're going to have to do stronger and more substantive testing. So it does make a big difference in the planning. You want to gain an understanding of the client's business and industry. You want to learn about how their business works. You want to learn about how their industry works, what's common practices within their industry. AICPA industry guides are good to learn about the industry, um, especially if it's a new industry that the audit firm is moving into. Identify the relevant financial statement assertions. This would be like existence and occurrence, completeness. Those you'd want to start identifying those based on the financial statements. Important to show the audit was planned according to standards. So basically, you would want to show in your plan that the audit was planned according to PCAOB standards. If it's examining a US GAAP company, or IASB standards if it's an international company that and you're examining IFRS, or you're using IFRS as the standard. Um, Staffing the engagement. Who's going to be the engagement partner? The engagement partner is going to be the main partner responsible for the audit. The quality assurance partner. This is another partner within the office who, at the very end, will kind of come in and do a quality check of the audit to make sure there's anything that they would spot, kind of give it a second set of eyes near the end to see if there's anything else that needs to be done. And then the audit staff, which would consist of the audit manager or audit managers if it's a very large audit, that are going to run certain aspects of the audit. They're going to be on site. And then what staff auditors are going to be there and what senior auditors are going to be there. It's important that once the team is gathered for a particular audit, they're going to do some planning meetings. These are kind of brainstorming sessions, and these are required. And basically, the team that's going to do an audit would get together, and they would, of course, have done some homework. And brainstorming sessions are also a good time if you're bringing in some younger auditors or less experienced auditors, for them to ask questions of those that are more experienced with the company or more experienced with the industry. and it's a good time for them to learn some things about the company and kind of how the audit's going to be done. And also during these sessions, you'll just talk about the audit, and it's a good way to kind of finalize some of your plans, come up with some contingency planning and things of that nature. Now, you would also, as part of your plan, want to look at the use of internal auditors. And the use of the company's internal auditors will many times come down to how strong is their system of internal controls. And if their system of internal controls is very strong, and if their auditors report to the board of directors or the audit committee, then many times companies or external auditors can use the internal auditors to help them gather some information and do some of the work on the audit, not making not relegating them to professional decisions that the external auditors only can make, but gathering information and just helping with the general audit. Now, you would also want to decide, are you going to need a specialist? Um, and specialists are what they are is they're specialists in certain areas that maybe the audit team is not specialized in. For example, what if this was a new client and they used an SAP system, and you're familiar, your audit is, maybe this is the first client you've ever had use an SAP system. So you might have to hire a specialist on SAP systems to bring you up to speed and to be part of the audit team for part of the enterprise resource planning system audit. Another example might be, what if you're auditing what if the company's a jewelry store and you want to evaluate their inventory? You might want to hire a jewelry expert who knows the quality of diamonds and can understand that, in order, again, to properly value the inventory that they're showing on their books. So again, audit specialists can be used and are hired to assist the audit team in various areas where they're needed. And the time budget would just look at how many hours do we expect to spend on the audit, and planning as such for how long do we feel like the audit's going to take. The time budget is easier if you're done the audit in prior years. If it's a newer company, if it's a first time audit, it's going to be a little more guesswork involved with that. But you can still kind of come up with a plan as how long you think the audit's going to take. Now, in a computerized environment, again, kind of like what I was talking, complexity, services outsourced. Some companies outsource some aspects of what they do, like they might you might outsource their payroll to someone like ADP. And so what you would do is you could either visit ADP, or you could rely on the audit of ADP. Couple of different ways you could do it based on what you felt was necessary here. And again, based on the complexity of their environment, you could have to bring in an outside expert. Again, kind of what I said, need for a specialist, kind of right here on the second paragraph. You could also use computer assisted audit techniquist, or known as CAT. What these are audit programs such as IDEA and ACL. And what they would do is auditors can use these to do a lot of the groundwork for the audit and to search for certain things that, and it really saves the auditor time. So, for example, here's kind of a way you could use a CAT system like IDEA or ACL. You could use them to pull from the client's GL, maybe any accounts that any expense accounts that have a credit balance, any revenue accounts that have a debit balance. So you could basically have these systems look for anything that's irregular, or you could have them pull some samples for you from the computer system. And looking for irregularities is something that, in past days of audit, before these systems, the auditors themselves would do, or work with the internal auditors to do this. But these systems can do a lot of the groundwork. Now, they do not replace professional judgment, but they can pull this information for you. The auditor would then look into them, and then the auditor would use their professional judgment on, ooh, this needs to be addressed, or okay, these are fine. I can see why these were done, or I can see why this happened. But it's a great resource for the auditor to help them do a lot of the groundwork, to save the auditor a lot of time, but it does not replace professional judgment of the auditors. Now, during the planning stages, a big thing you're going to do is you're going to examine materiality. You want to find an appropriate level of materiality for the financial statements. And it is a matter of professional judgment by the auditor. It's expressed as a specific amount. Now, usually from the top, with an overall level of materiality broken down into certain accounts. Auditors typically use profit before tax, total assets, or total revenues as benchmarks for materiality. So you might say 1% of profit before tax. Any errors or things that you find above that need to be corrected would be considered material. And you would ask the company to make those corrections. Now, here's some other things with this. Fraud of any size is deemed to be material. So if you, as an auditor, if you find fraud, you're typically going to take that right to the audit committee. The audit committee was something that was set up as part of Sarbanes-Oxley. And they're basically like, you've got the board of directors and you've got the audit committee. The audit committee is independent, and they kind of act as a go-between between the company and the auditors. They hire the auditors. And basically the auditors, and typically internal auditors also, will report directly to the audit committee. And so any type of fraud that was found would be reported to the audit committee. Or if it's a smaller level fraud, would be reported to maybe one management level above. Now, if they find fraud, of course, with the executives, it's going right to the audit committee. So again, fraud of any size would be considered material. A couple of other things to consider here. Materiality can be considered if a small error turns a profit into a, turns a, I think I've got this backwards, a loss into a profit, or helps a company meet some type of earnings goal. So what if there was a very small error that helped the company go from meeting Wall Street earnings goals, help the company basically meet Wall Street earnings goals when they would not have otherwise? Even though that's a small error, it would be considered material because it helped the company meet Wall Street goals, which greatly can help a company's stock price by meeting the goals versus the stock price dropping if they don't meet these goals. Or what if it turned a loss into a profit? Again, it looks better if a company turns a profit, even if it's just a small profit. And here's another thing with this too, is you got to consider the cumulative effects. And what this means is that if you've basically set materiality, and you've got materiality set for here, 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 and here, different areas of the company, different parts of the company. But if you would take the total of those, and it would overcome the materiality threshold, then that's what you've kind of got to be aware of. Are there some small errors that if they were added up together would be material? That's something you've got to watch for also with this. Now, obtaining audit evidence, you want to look at the management assertions, existence. We looked at these in the last chapter, but remember their existence or occurrence, rights and obligations, completeness, valuations and allocations, and presentation and disclosure. You would gather evidence and come up with audit procedures that best are the best ways to gather this evidence. Another thing you're going to see is that it's broken into cycles. And you're going to see this in chapters, I think, 9. You're going to see this in chapters, I think, 7, 8, 9, and 10. We're going to look at each one of these cycles: revenues and collections, acquisitions and expenditures, production cycle, and finance and investment cycle. Now, why you break it into these cycles, or why you break the financial information of a client into these cycles, is because think of it this way: by verifying one, you're really verifying the other in a way as well, or you're gathering evidence to support the other as well. So think about it this way: if you prove accounts receivable, that could also be seen as approving a sale. If you prove, okay, their total for accounts receivable is right, then that means that portion of sales, you verified that as well by basically doing the same thing. So by breaking a lot of things into cycles, it improves the efficiency of the audit, because gathering evidence for one can also work for different aspects of that same cycle. So that is one reason that auditors do that. 8 general procedures for gathering evidence. You would inspect records and documents, like shipping documents that something was shipped out, or receiving documents that something was received, invoices, purchase orders, things of that nature. They might be from the company or they might be from outside the company. One thing to think about here is that documents coming from outside the company are deemed to be a stronger source of evidence than those generated within the company. But again, both can be evidence. You would want to inspect tangible assets. So what this means is that you're going to observe inventory counts. You're going to verify inventory totals. You're going to verify fixed assets. If a company states that we've got a plant over here that has all this equipment in it, you might need to drive over and check out and make sure that what they're saying is actually there. It actually exists. You're going to do observation. You're going to observe the way that the company does certain processes and certain things that they do. Again, observation is also another good way to learn about the business and how the company operates. You're going to inquiry. You're going to ask a lot of questions to the company about different things, and they're going to give you answers. And again, kind of like it goes back to what we were talking about in chapters 2, is that you don't always take their word for it. You write down their response and then you corroborate or verify their response. But you're going to ask a lot of questions about different things. Questions are a great way to learn about the company, learn about what they're doing, why they made certain moves. It all goes into your process of audit. Confirmations. Confirmations are typically outside confirmations, and we're going to look at them a little bit more later in depth. A lot of these things that we're talking about here, we will later. But confirmations would be like confirming bank account balances with the bank. They would be like confirming accounts receivable balances with outside companies. Again, these would be outside confirmations that would be useful to verify what the company is reporting on their financial statements. Recalculation or reperformance. These would basically be just rerun the numbers. Check the calculations on interest, check the calculations on depreciation, reperform certain processes and see if they come out the same. And analytical procedures, what analytical procedures are is they're very useful in the planning stages, but they're also very useful in the kind of the end and kind of the wrap up and kind of going over the last bit of audit information to do some verification. The quality control partner will a lot of times use analytical procedures to do kind of the last ditch kind of overview of the audit before the company signs off on it. What analytical procedures in the planning stages, how they're used is they would be kind of like looking at things such as trends, like percentage changes from year to year, change in financial ratios from year to year, and kind of identifying areas that could be issues, where there could be problems or could be issues, to alert the auditor to look at these areas more deeply or further. So analytical procedures are a big part of the planning process. And audit documentation, of course, as the auditor, you've got to keep up your documentation of support. Remember, one of the things that I talked about in chapter 2 was that auditors will get audited every 1 to 3 years by the PCAOB. And so they want to have documentation to support how they did certain audits and why they did certain things within the audits. So they're going to keep permanent files on every client. And permanent file would be things like their records of incorporation. It would be the prior year's audit. It would be basically a lot of things, you know, uh, that information about the board of directors and their articles of incorporation and a lot of more permanent issues with the client. Now, the current files would be, I take that back, what I said a moment ago, the prior year's audit, that would actually be more in the current files. So you'd have in the current files, the prior year's audit and everything that you've gathered of evidence on this year's audit would be shown in the current files as well. So permanent files are more company information that's going to be passed forward from audit to audit. And the current files are going to be more last year's audit plus everything you've gathered from this year. So it's going to be where all your documentation and all your support and evidence is going to be shown for the current year's audit. Lead schedules and supporting schedules, these would be more schedules that the audit keeps to make sure that they're keeping up with, that they're on time with their audit, that and also basically they would be like the lead schedules to be like the main accounts, and the supporting schedules would be the supporting accounts and kind of supporting documentation that supports the audit of those main areas of the audit. So lead schedules and supporting schedules. The audit documentation must be retained for 7 years after completion of the engagement. And audit documentation must be finalized within 45 days of the audit report release date. Auditors can add but not remove materials after this 45-day period. So, and this is very important for your PCAOB audit, is that you can't take away things after that 45 days. You've got 45 days to update it and make sure you've got a very clear record that supports what you did on the audit. And again, this is something that if the PCAOB were to come in, audit your firm, they're going to pick certain audits to look at. And if they pick your audit, you want it to be complete and you want all the rules to shown as being followed in terms of things like the 45-day rule and keeping it for 7 years and the like. So again, this is part of preparing it for possible audit by the PCAOB. And that is all of chapter 3. Take care and have a great day. Bye-bye.